I'm Jeff Chester. I'm a partner at Morrison Foerster, also known as MOFO. We are a large international firm with offices all over the world. So the tax reform legislation has had a major impact on the entire industry. In 2017, when it was being talked about, there was major structural provisions that were embedded into the transaction. So the tax equity market, upon which the projects are largely financed, continued to work and adjusted, and the structures accommodated potential change in law under numerous different potential assumptions. And then in November, when the House introduced the legislation, that had the effect of bringing the entire market to a halt, because there were a number of provisions that were negative to the tax equity market and to renewables in general. In particular, there was a reduction in the value of the production tax credit back to 1993 levels by eliminating any inflation adjustment that had accumulated throughout those years and eliminating the inflation adjuster for the future. There were also other provisions in that bill that negatively impacted renewables. The industry kicked into gear, led largely by AWEA, but also by SEIA, the Solar Energy Industry Association, ACOR, and other trade associations, together with all the friends and allies of the industry throughout the country, and showed that the industry really does have very deep and strong bipartisan support. And then that was reflected in the Senate bill, which preserved the value of the tax credits and largely eliminated the other provisions that were negative to the industry. Although there was at the end a surprise in that bill called the B tax that will potentially have impact on tax equity financings into the future. So after the bill was enacted, the industry heaved a huge sigh of relief, and deals that were held up pending the enactment of the bill were closed. So the end of the year saw a very large number of transactions closed. And now the tax equity providers, of which there are approximately 15 in the wind industry, another 10 or 15 in the solar industry, pausing somewhat to assess the impact of the BEAT tax on their capacity and potential to continue to participate in the same manner as they are now. We believe that most of the current tax equity investors will continue to participate, and that the impact still not yet to be felt. We're waiting for pricing to reopen in 2018, but we're not expecting a significant impact to price or structure based on the legislation. We expect strong growth on the part of corporate off-takers to participate in the both wind and solar markets over the coming years. This is a result of many leading companies announcing that they want to go green. It's reflected in different ways, including direct investments into wind projects, buying RECs on the open market. RECs are renewable energy credits, buying green power in the open market, and entering into long-term power purchase agreements. We expect the trend towards power purchase agreements to continue, Over the last couple of years, there's been very significant participation. In 2017, for example, approximately 45% of all new wind PPAs were signed up by corporates, as compared to 36% in 2016. And that's not just percentage, but also an amount. Last year was approximately 2,500 megawatts of wind PPAs by corporates, as compared to approximately 1,600 megawatts of PPAs, new wind PPAs signed up by corporates in 2016. And we expect that trend to continue, particularly as against announced commitments by leading companies. Many of the leading companies have announced their intention to go green, go 100% green, and we're nowhere near fulfilling those commitments. Approximately 25% of those commitments have been fulfilled, and I think I've heard we're well in excess of 10 gigawatt capacity, maybe 20 or 25 gigawatt capacity there for renewables, just to fulfill announced commitments. So again, we expect very, very strong participation. And it's a very good thing for the industry because it diversifies offtake, and it also enables projects to be built, which otherwise couldn't without that type of offtake arrangement. Now, the one thing I would say to the industry in general and to the utilities and corporates out there, and that is, at the current price of wind, which is historically low, we're talking about LCOEs well below the cost to build a new gas power plant, for example, well below the cost of coal and nuclear. And at these prices, we expect, at these prices, I wonder, why aren't more corporates and utilities, for that matter, buying as much power as they can get their hands on? So, if we're talking about corporate PPAs, the type of buyers, I think that any company with a significant energy load requirement, consumption requirement, is a potential buyer. It doesn't have to be a leading company. Companies like Google, Apple, other large companies, tech companies, Home Depot, they're all participating in this market. But you don't have to be a big company to participate. You can be a company really of any size to participate. And structures are being developed now to accommodate smaller participation. So you don't have to sign up for the output of an entire wind project. You'll be able to sign up for much smaller increments, much more closely aligned to your actual consumption. Now, in terms of investors in projects, which is a different segment of the market, we see the capital requirements are so huge that the big players in this market are what we call strategics, which are utilities or utility affiliates. We also see large private equity funds coming into the market, and we see that trend continuing. So I say that I go back to the beginning of time in this industry, really all the way back to the 80s when the first projects were being built in California. At that time, those turbines were 65 kW turbines, and current turbines are 3,000 kW in excess of that. If you look at offshore turbines, we're talking about 6,000 kW turbines. So the size and the capacity and the efficiency of turbines has increased really tremendously over the years. And then that flash forward to the end of the 90s, which is what I call the beginning of the common era. And I've been involved full-time since then. 1997 is when I started working full-time in the renewables industry. And we've seen it evolve tremendously since then. Back then, in those early days, we're talking about there was no tax equity market. Tax equity market didn't come into place until 2003. There was one lender in the market. There was not an equity market, an active equity market. There were no private equity funds playing in this space. So we've seen all of that happen over the last 15 to 20 years. For example, in year 2000, OWEA, which is the American Wind Energy Association, at their annual conference, they crossed the benchmark of 1,000 attendees. In 2008, I think they hit 20,000 attendees, together with solar, another 20,000 attendees at their annual conferences. So we're talking about annual conferences now that are attracting 40 to 50,000 people. So the industry has really grown tremendously. And now we have a very active set of developers. We have tremendously competitive and deep liquidity bank market. We have a very highly evolved and sophisticated tax equity market. We have players throughout all segments of finance and industry participating in this market. And so we went from, wind went from very marginal technology, and solar was non-existent, to over the last 2 or 3 years, wind and solar combined accounted for more than 50% of all new installed energy capacity in the U.S. And really, I think the future is ours, because according to a recent Bloomberg presentation, we're close to the tipping point. The tipping point is when the cost of a new build wind or solar plant is less than the cost to operate an existing coal plant. So even though our dear president, embraces what he would call beautiful clean coal, which I would say is a double oxymoron, I think the future belongs to wind, solar, and renewables, and it does so not just because of desire to have emissions-free output, and to protect the environment, and to reduce carbon emissions, and to mitigate climate change. It does so for good old American capitalist reasons. It's just the most efficient and economic technology and way to deliver power that there is out there.